Understanding Knock-in Options, a comprehensive guide. In the world of financial derivatives, knock-in options are sophisticated instruments that cater to specific trading strategies and risk management techniques. They are categorized under barrier options, which are defined by the triggering of certain price levels within the life of the contract. What is a knock-in option? A knock-in option is an option contract that is not activated until the underlying asset reaches a specified price level, known as the barrier. Once this barrier is breached, the knock-in option knocks in and behaves like a standard option, allowing the trader to leverage their position. Knock-in options can be classified into two main types, down-in and up-in options. Key takeaways. A knock-in option activates when a specific price barrier is reached by the underlying asset. There are two types of knock-in options. Down-in options, triggered when the price falls below a certain level. Up-in options, activated when the price exceeds a specified level. Understanding knock-in options versus knockout options. Knock-in options are often compared to knockout options, which function oppositely. While knock-in options come into existence only once the barrier is breached, knockout options extinguish upon reaching a specified price point. Price discrepancies and premiums. Generally, barrier options, including knock-in options, seem to entail lower premiums compared to their vanilla counterparts. This reduction in cost is primarily due to the conditional nature of these options. The requirement for the underlying asset to hit a certain price often increases the chances that the option will expire worthless, making them less favorable in terms of guaranteed payoff. Traders might opt for these less costly options if they have confidence that the underlying asset will meet the barrier conditions. Practical example of down-in knock-in option. Let's take a deeper dive into a down-in option. Assume an investor purchases a down-in put option with barrier price, $90. Strike price, $100. Current underlying price, $110. Expiration, 3 months. In this scenario, the put option will only come into effect if the price of the underlying asset drops to $90 or lower. If this occurs, the option assumes its qualities as a vanilla put option, allowing the holder to sell the underlying asset at $100, regardless of its current market price, if below $90. However, it is essential to understand that simply reaching the barrier does not guarantee profitability. The options holder will need the underlying asset to remain below $100 to realize a profit when exercising the option. Practical example of up-in knock-in option. On the contrary, an up-in option functions when market conditions are bullish. For instance, consider a scenario where current underlying price, $40. Strike price, $50. Barrier price, $55. Expiration, 1 month. In this situation, if the underlying asset's price rises to $55 or higher within 1 month, the up-in call option activates, and the trader gains an opportunity to purchase at a strike price of $50, potentially yielding a lucrative investment. Conversely, if the price does not breach $55, the option will expire worthless. Conclusion. In conclusion, knock-in options are specialized financial contracts that offer unique trading opportunities and can play an essential role in financial strategies. Because their existence relies on specific market conditions, they are an effective way for traders to manage risk and reduce costs while engaging in speculative trading. Understanding the nuances of these options, such as the mechanics of barrier levels and the differences between down-in and up-in options, allows traders to devise strategies that align with their market predictions and investment objectives. As the financial markets evolve, knock-in options remain a complex yet valuable tool in the derivatives landscape.